Oil markets, oil prices, where do they come from? Who sets them? Who are the buyers? Who are the sellers? That's what we're going to talk about today. This is very 101. Okay. But there are some little keywords in here I want you to pick up on because they're very important, and hopefully we will kind of wind down some of our political chatter because we'll recognize that political chatter at times was written by people like me 13 years ago. All right, futures contracts. The oil markets are in the futures market. We do not speculate in options. There are differences between options and futures, but one of the fundamental differences with an option, when you buy a call option or a put option or sell a call and a put option, if you buy a long call today on Exxon at $90 for June 2022, you have purchased the right, but not the obligation to buy 100 shares of Exxon at that stock price on that expiration date. The futures contracts are binding agreements. They're different. The buyer and seller are obligated to make that purchase. Now, there are two types of people who trade oil. And I'm not talking about you. I'm not talking about me. I'm not talking about what my wife does. The primary people who are doing this are hedgers and speculators. Oh, and let me answer that question for you. Options. Profit calculator.com. All right. So hedging is designed to protect yourself, obviously, right? You want to, if you have 100 shares of Apple stock at $165 and you own it for the long haul, but you're worried about a significant downturn, you might buy a put on Apple at 150. And if the stock falls below 50, you have the right, but not the obligation to sell your stock at 150 on or before that strike date. Hedgers do something very similar. They are effectively using futures contracts in order to hedge against volatile price movements. Very relatively simple. So if you are an oil producer and you are producing oil at $100 a barrel today, but there are concerns that the market might go down over the next 12 months, you would potentially hedge by maybe selling some of your contracts at 95. Maybe you go up the ladder. Maybe you looked for contracts at 105. Or there's speculation oil is going to go from 100 to 150. Maybe you sell at 120, yet oil goes all the way back. You're using it to hedge. And a lot of this is much easier in the oil markets than it is in the agricultural markets because agriculture takes longer to produce. Obviously, you're growing it in the fields, where oil, you're pulling it out of the ground and then moving it. Oil hedging is a little bit easier and a little bit less volatile. Speculators are doing what we do, right? We speculate on the potential price movement of something at a later date. And at the same time, a company that is going to purchase purchase oil for maybe refining or maybe for potential to develop plastics or whatever it is that they need it for, they will speculate on prices as well. They will use hedging as a way to ensure that they lock in a price that they want at a specific level, but then they will speculate elsewhere and look for opportunities to bring in at a lower price, where the producers will speculate on prices and try to get higher prices where they can. So those are the two mechanisms of the market. Everybody following me? Eric, does that make sense?
I understand everything you're saying, and I'm loving it.
All right, so let's talk about this. There are three primary benchmarks in the world. There is West Texas Intermediate. That is U.S. oil. That is the U.S. markets. I'm going to pull this up real quick, and I'm going to show you because we talk about it every day. Over here on FinViz, you see crude oil WTI. That is the U.S. benchmark. That is priced in New York at the NYMEX. Crude oil Brent. That is a second benchmark. This is the global benchmark. It is priced in the North Sea, north of Scotland. That is where Brent, where the Royal Dutch Shell and that production really had kicked off. That is the global benchmark. But there's a third one now, and that is Dubai. Dubai has its own benchmark as well. That really covers the Middle Eastern. Now, those three benchmarks, we talk about WTI and Brent crude the most because Brent crude and WTI dominate the market. Dubai has its local market. It's very important, and it's going to be even more important in the decades ahead. But I want to point this out. There are hundreds of different types of crude around the world. There are multiple types of crude in Saudi Arabia. There are multiple types of crude here in the United States. There are multiple types of crude in South America. What matters at the end of the day is sulfur content and location. So in the United States has very low levels. WTI crude is known as a quote unquote sweet crude. That means it has less sulfur content. It is easier to process. It is easier to refine. Dubai crude is medium crude, medium light, medium sweet, a little bit more sulfur. Brent crude is heavy. It requires far more refining. And what's interesting about this is that Brent crude for a long time traded under WTI for a long time. And it was because WTI was more desired by refiners. It's cheaper to refine. Brent crude, higher sulfur. Now, some places in the Middle East have extraordinarily high levels of sulfur. So you'll hear a lot about refining networks. We're going to talk a little bit about refining networks and what they mean. It's very important, but just for now, know we talk about West Texas Intermediate and Brent all the time. This is the global benchmark, Brent. WTI is the U.S. benchmark. Dubai crude, in a couple of years, maybe 10 years from now, 5 to 10 years, it will show up on CNBC's ticker, and we will talk about it because it is going to be very important to the India and the Chinese markets in the future. Who buys crude? The United States buys more crude than anybody else. Hands down. We use 18.2 million barrels per day in 2020. We produced 11.3 million per day. Now, that does not mean barrels of oil equivalent. That means barrels of oil, and I'm going to get into the difference between that. China uses 12.7 million per day. That is 50%, but their average consumer uses 50% less oil than the U.S. consumer. So when somebody says that the U.S. consumer is going to increase its use of oil by 2.5% next year. In order for China to match that, the average consumer would effectively need to increase their consumption by 5%, because they're already consuming well less than us. So you can see on this chart, the United States is about 25% of global purchases. China's about 8%, Japan's about 6%, and the EU is 18%. Who sells the most oil? Okay, the United States is technically still the largest producer in the world. We're doing about 11, 12 billion per day. Saudi Arabia, Russia are second and third, and Canada is fourth. However, OPEC is critical. OPEC is the world's largest global oil cartel. They own the bulk of the reserves in the world, and they work together in order to manage the production of their member states. So let me take you through OPEC real quick. OPEC was founded in 1960. They have 13 member nations. It is a cartel. If you've ever seen A Beautiful Mind, John Nash, he created effectively the game theory of cartels, in that cooperation is better than competition. So if these countries were pulling oil out of the ground and trying to sell it on the open market, there would be a free-for-all because they'd be producing as much as they possibly could in order to get as much as they possibly can for their oil. Well, what this group did, they banded together, and then they set production targets for each nation in order to maximize profitability. They all worked together in order to reduce their production, to reduce the amount of available oil on the global markets. And by doing that, it drives up the price. Now, not to be undone, the United States dramatically increased its production in 2008 thanks to the shale revolution. We became the largest producer in the world. We were reliant on OPEC, right? Well, OPEC went and started to band with a handful of other nations, that in a group that is called OPEC Plus. And OPEC Plus consists of Russia, Mexico, Kazakhstan, South Sudan, Oman, Brunei, Bahrain, and Azerbaijan. I can never pronounce that, no matter how many times I try. So you have nations like Venezuela, you have Saudi Arabia, you have the UAE and Kuwait and Libya and Nigeria, and every single one of these countries has different break-even points. Every single one of these countries wants higher energy prices because every single one of these countries heavily relies on oil in order to finance their state governments and all of their welfare programs. So a country like Saudi Arabia that just came out of this crisis, that has expanded its debt balance sheet, that is working to increase the amount of things that it can provide for its citizens, they want higher oil prices. They are going to keep their foot off the gas as much as they possibly can because they want oil prices to get to $100 per barrel. However, sometimes OPEC messes up. Sometimes OPEC makes a huge mistake where they don't cut production because they don't foresee that global demand may potentially fall. That happened last year at the onset of the 2020 crisis. That also happened back in around 2011 through 2013 when oil prices were up around $100. They did not cut production. And as a result of that, oil prices fell to 40. So OPEC is the most important component of the global energy sector. They have roughly 79.4% of the proven oil reserves in the world, and they account for, I believe, anywhere between 40 and 45% of global output. That number actually might be low on my estimate. I have not looked at the EIA number lately. That opens the question of who sets the price. Well, the price is set by you and me. It's set by oil traders, refiners, producers, hedge funds, pension funds, speculators, your grandmother if she's taking a long-term or short-term position on the NYMEX crude. But I point this out. Supply-wise, OPEC Plus is the biggest driver of supply in the market. It heavily dictates the price on the supply side of the quote-unquote supply and demand curve. Demand heavily, obviously, in the United States, even though we do a lot of production of our own. But China is increasingly increasing its energy demand. And as a result of that, China is also getting closer with a lot of those nations in the Middle East. So they are effectively trying to drive more of that production to them. And that creates issues of energy security for the United States, which opens up this question. We've talked about this. We've gotten into this in the chat. We've talked about energy independence. Okay. Energy independence. What is that? Well, it's the idea that the United States would be able to produce all of the energy and live off of it, and we would not need anybody else. Okay. Energy independence is a political term, and I know it because I know the person who wrote it. I worked at a political shop in 2009, 2010. One of my big clients was the American Petroleum Institute in the wake of the BP oil spill. So I know how the sausage is made on language around this. The more important term is called self-sustaining. That is the economic term. Energy independence sounds really patriotic, right? Well, self-sustaining is the real term. And that is the ability to produce enough of the energy that it meets local demand. This is a term that agricultural economists use on a regular basis. We'll talk about how the United States is self-sufficient in corn. The United States produces way more corn than it could ever eat. That's important. But the more important component of quote unquote independence and self-sustainability is security, energy security. And the United States does not have energy security. We are reliant on Canada. We are reliant on other exports. Keep in mind, the United States is massive. I believe something like 80% of our population lives within 100 miles of the ocean. I have to go back and look at that, but that's seems like an arbitrary enough statistic that I would know. Our refinery networks are in the Southeast. Our people live primarily on the coasts. We move things across pipelines, but even then, that's not the most secure way to do things. We move a lot of things by rail. We have to import into the Gulf Coast in order to produce and move things through our refinery networks. And that's really, really critical. So while we might have had, quote unquote, we might have produced more energy than we did for the first time in 1957 and 2019, it doesn't necessarily mean that we are self-sustaining, because you have to be able to get the crude and all of the other different types of energy to everyone in the nation. And we are very good at getting it to the people in the Northeast. We're pretty good at getting it to people in Texas, but on the West Coast, in certain areas, some of these kind of expanding places around the country, we're not as good. And you can see that in the fluctuations in oil prices that are dependent, or in gasoline prices that are dependent of policy like tax policies in different states. There are three components to the energy sector in the United States. There is the upstream, and these are the energy exploration and production companies. Think of a company like Diamondback or EOG Resources, which is part of the Money Morning Live portfolio. These companies pull oil out of the ground. Now, I'm going to talk about Chevron and Exxon in a moment, but I want you to just think of the pure play E&P companies. That's what we call them. Diamondback, they're in the Permian Basin. They just pull oil out of the ground and they sell it. And these companies typically use the futures markets to hedge. They'll speculate a little bit when trying to sell things. They'll keep things in order. But remember, things typically operate on the futures market. If things need to go to a spot market, those spot markets exist where you can purchase fuel at whatever the current price of today is. Remember, the futures go out a few months. I believe we're on the January, maybe the December contract right now. So that's very, very important. Delivery is always typically through Cushing, Oklahoma. That's the primary point. But again, it doesn't have to go there at the end of the day, because we are not operating like a 1920s Chicago futures market anymore, where you deliver the cattle to the feed lots and then people pick them up. All right. So the benefits of investing in the upstream components of the oil markets are, when the oil prices rise, those stocks go higher. These companies typically have a good access to the capital markets. They're able to drill. Usually, before we got into the big climate change debate, this was, or at least within the bond markets with ESG, this was a relatively stable industry for lending. These companies would go out, get money, expand, build their reserves, and as oil prices rise and fall, these companies can go higher or lower. So if we predict that oil prices are going to go to 120, a company like EOG Resources or Diamondback, which is FANG, they're going to do a lot better. The second component is the midstream. And we talk about this on a regular basis. And remember, you are absolutely right. We are LNG rich. We're going to talk about that in a moment. These companies generate revenue through the center of the supply chain. So they do storage of oil and gas and gasoline, oil and gas. Let's stick there. It's oil and natural gas. Pull it out of the ground, put it into pipelines, put it into storage, put it into places where you're going to generate capital like you're charging rent. So these typically have very strong, reliable cash flow, and it doesn't matter what the price of oil is, because you still have to move it through the supply chain every single day. So they're charging rent. It's like trying to cross a bridge from one side to the other. They operate the bridge. And what's interesting about this is the tax structure in the United States allows for what are known as master limited partnerships. Because the companies generate 90% of their revenue from the assets, which are pipelines or their storage facilities, they are able to skip one round. They can skip corporate taxes. They are structured differently, and because of that, they pass on their profits, roughly 90% of their cash flow, directly to their shareholders. So enterprise product partners, energy transfer, they operate under those environments. And that's why you can see a 6% to 10% dividend with potential appreciation upside as they expand their businesses across the country. The last part of this is the downstream. And the downstream are the companies that refine and process crude into products, right? So you're turning oil into gas or plastics or jet fuel. These companies tend to be a little bit more speculative on their trades. They don't want to have to lock in, too far into the future unless they know that it is going to be beneficial for their profit margins. They can struggle when oil prices rise because they operate under tighter margins. And one of the things that's extraordinarily confusing about what's happening right now, the U.S. government is going to release they're going to double down on the idea that oil prices are going to go lower. They're going to release oil from the strategic reserve. And as a result of that, refineries that want to have to avoid refilling the SPR at higher prices at a later point, they're going to have to be forced to buy the 2022 oil futures contracts or opt out of this exchange with the White House entirely. As a result, oil prices are probably going to go higher. So this is going to be a very short-term thing here. You might see a little bit of a bump in these companies like Valero because the lower oil prices coming from the strategic reserve could easily help their profit margins for a short period of time. But you got to keep in mind the SPR has to be refilled. It'll be refilled at higher prices. And as a result, you may very well see higher oil prices in 2022. And that's one of the reasons why guys like Kyle Bass, who's a hedge fund manager, came out and said, this is the stupidest thing they could possibly do. Oil prices are most likely heading to 100, 120 next year. Refineries, one of the more important things that people need to know, refineries typically never operate above 90% capacity. So there's a reason why we're not flush with cheap gasoline all the time. It's because our refineries, we don't build a lot of them here in the United States. Our network is along the Gulf Coast here in the United States, down where I am. Places like California are trying to shut down their refineries because of their climate policies. But these refineries typically never run above 90% because they need to have excess capacity in case of greater demand. And Ken pointed out that last point. You're absolutely right. OPEC is planning to respond to this coordinated effort because they might just not increase their production for the year ahead. And that would be relatively bad. Now, a real quick question. What do you think the difference is between the United States and the other nations? This is in place that I've traveled to, Nigeria. This is flaring at night. This is effectively where your refineries, you just burn everything because you can't get rid of all of your crude, or you can't get rid of all your natural gas. You think we do this here in the United States, chat? I would say it is not a good idea to invest in Valero right now. So flaring, yeah, we do it, and we do it heavily up in the Bakken. I read an article earlier that we might at times burn upwards of 19% of the natural gas they pull out of the ground at the place where they're pulling it out, because they don't know where to put it. They have to straight up burn it into the sky. So that is a serious issue. And moving forward, there's going to be laws that are likely going to impact that. That will impact producers, how much crude and natural gas they pull out of the ground. So a recap, this is what the supply chain looks like: offshore and onshore pumping platforms, processing, storing, pipeline transfer, distribution, purification, and ultimately selling it to the people. But in reality, this is really what it looks like. There is the upstream, the midstream, the downstream, and then back to the midstream, because once you refine it, turn it into gasoline, you have to store it again, you got to transport it again, and then it ends up in your home, heating products, propane, things like that. So that is it. That is the global oil market in 20 minutes. What do you think, Eric?
I think you did a great job breaking that down, Garrett.
I'm glad you enjoyed it.
So entertaining.
I hope that everybody's
so fun. It was awesome.
I hope everybody's thoroughly confused. No, I'm kidding.